Do higher taxes always mean more revenue? The truth behind the Laffer Curve. Have you ever wondered why raising taxes doesn't always lead to more government revenue? It sounds counterintuitive, but there's a fascinating economic model that explains this, the Laffer Curve. In today's video, we'll break down this concept, explore its real-world applications, and uncover why sometimes less can actually mean more when it comes to taxes. Upward trend. What is the Laffer Curve? The Laffer Curve is a theoretical model that illustrates the relationship between tax rates and total government revenue. At a 0% tax rate, the government earns nothing, obviously. But at a 100% tax rate, the result is also zero revenue, because people have no incentive to work, invest, or report their income. Somewhere in between these two extremes lies an optimal tax rate, a sweet spot that maximizes revenue without discouraging productivity or economic activity. The Laffer Curve reminds us that taxation isn't just about math, it's about human behavior. The model was popularized by economist Arthur Laffer in the 1970s. Legend has it that during a meeting with U.S. officials in 1974, Laffer sketched the curve on a napkin to illustrate his point. Both a 0% and a 100% tax rate result in zero revenue, so the optimal rate must be somewhere in between. That simple sketch became one of the most debated ideas in modern tax policy. So how has the Laffer Curve played out in real-world economics? President Ronald Reagan reduced the top marginal tax rate from 70% to 50%. Supporters argued it spurred economic growth and maintained revenue levels, aligning with Laffer's theory. Critics, however, pointed out that the federal deficit ballooned, suggesting the results were mixed at best. President John F. Kennedy advocated for across-the-board tax reductions. The 1964 Revenue Act slashed income tax rates, and the economy did grow. But again, some economists argue the growth wasn't solely due to tax policy, other factors were at play. While the Laffer Curve is an elegant theory, applying it in practice is far from simple. The curve's exact tipping point, where higher taxes begin to reduce revenue, depends on a range of complex factors. The elasticity of taxable income, the state of the economy, cultural attitudes toward taxation, levels of tax avoidance and evasion. In other words, there's no universal tax rate that works for all countries or time periods. It's dynamic and context-specific. The Laffer Curve serves as a reminder that tax policy must strike a delicate balance. Raise taxes too much and you risk shrinking the tax base. Lower them too far, and you may not have enough revenue to fund essential services. The challenge for policymakers is finding that invisible midpoint, the one that generates enough funding without stifling economic energy. Economics can be complex, but we're here to make it clear and practical. If you found this video helpful, don't forget to like, subscribe, and drop a comment below. For more real-world breakdowns of economic ideas and their impact, stay tuned, and we'll see you in the next video.